average consumer debt in America keeps climbing higher and higher with every passing year, and most families feel trapped in all of the payments that they have to make. Credit card payments, mortgage payments, car payments, HELOC payments, student loan payments, you name it. The list goes on and on. In fact, most of us feel like we are on a hamster wheel, just running, paying, and not really getting anywhere. So today we're going to talk about how to get out of this vicious cycle that we call debt, and we're going to cover 3 most common strategies that have proven to work for many people in the past. Those being debt snowball, debt avalanche, and debt consolidation. So without further ado, let's begin. First up is debt snowball. Now this one's very interesting because it is rooted in human psychology instead of the finance. And I'm not going to go into too many details about it other than tell you that it feels really good to be able to pay off an account in full. And that's what debt snowball capitalizes on. It allows us to close that very first account very quickly. So that feeling of accomplishment and feel good that we have can be used to stay motivated to go after the second account, and then the third, the fourth, the fifth, however many you have. Now, the way it accomplishes this objective is by listing out your accounts in order of balance, from the lowest balance all the way to the highest balance. So in our example, we have 3 accounts, a credit card, a car loan, and a mortgage. And we're going to list out the balances from the lowest, $1,000, second lowest, $15,000, and then highest is $50,000. Now you can total your total balance owed, so you know exactly how much money you owe to everyone. But if you feel uneasy or unsure or just plain scared to know how much the total amount is, then you don't have to. We actually don't need it for this exercise, so you can just skip that step and move on to the next one. Now, the next thing you want to take a look at is the minimum payments that you have to pay on each account every month. In our case, our credit card minimum payment is $50,000, and car loan is $350, and mortgage is $800. Now, these balances you do want to add up to know how much exactly you need to be paying every month to stay current. And again, for us, that's $1,200. Now, a word on minimum balances. You absolutely can pay off your debt by paying just the minimum balances owed. However, it's going to take a really long time to do that. So I always recommend that you throw in at least a little extra money towards debt repayment to help expedite that process a little bit. So in our example, let's say we were able to come up with an extra $100 a month. So instead of paying $1,200 in minimum payments, we will be paying $1,300 to help pay off debts faster. Now, last but not least, we need to know where this $1,300 is going to go to help us get to our objective of paying off at least one debt. And what we're going to do, we're going to pay a minimum balance on every account except for the very top one. So we're going to go from the bottom up, minimum balance here, remaining balance of $150 we're going to pay towards our credit card. Now, being able to pay $150 towards our credit card will help us pay that card pretty fast. In this case, just at a first glance, it will probably take us about 8 or 9 months to pay off that card in full, which, yay, it's going to feel really great at that point. You're going to feel this great sense of accomplishment being able to close that card and not have that debt anymore. Now, what happens next is extremely important and super crucial. Now, in most cases, what happens is once we pay off an account, we feel like, oh, great, I don't have to spend this $150 anymore. I can take it and use it towards my daily spending. I can get that new clothes that I've been wanting. I can have more entertainment that I've been wanting. I can take my family on this new activity that I've been wanting. So this $150 will come really handy for all sorts of things. And this is exciting and great, and it's nice to get that money back in our daily spending. But what Debt Snowball tells us that in order to be able to get rid of your debt once and for good as fast as possible, you need to resist that temptation to pull that $150 back and use it for your daily spending. Instead, what you're going to do is you're going to take this $150 and you're going to roll it into your next debt, which is car loan for us. So instead of paying $350 for our car loan, we now going to pay $500 here. Now the same thing is going to happen. Now that we're paying more on our car loan, we will be able to pay off this loan quite a bit faster than we originally expected. But it's probably still going to take us a couple years, 3 years maybe. But once you're done, you're going to, again, instead of pulling this $500 back into your daily spending, you're going to roll it into your mortgage next. So again, instead of paying $800 towards our mortgage, we're now going to pay $1,300 towards our mortgage. So again, by being able to send more money to the bank here, we'll be able to pay off the house as fast as possible. And then at that point, we will be debt free. Now, this whole thing hinges on a couple of assumptions. Number one, you're not getting any new debt as you're paying off your balances. And number two, you always roll off your paid off payments into the next line item on your list of debts. So as long as you can do that, you'll be paying off your debt in no time and feeling excited and motivated. And before you know it, you'll be able to pull this $1,300 back into your life too. Our second strategy today is debt avalanche, and this one is pure finance. Now, debt avalanche is trying to save us as much money as possible in interest by organizing our debts from the highest interest rate to the lowest interest rates instead of the balance like we did in the previous example. Now here we're going to use the same 3 accounts, a credit card, a mortgage, and a car loan, but now we see that credit card is the highest interest at 25%, mortgage is second highest at 5%, and car loan, we got really lucky and qualified for special financing, so now our car loan is at 0%, and it's the very last priority on our list. Now the rest of the information you'll need is very similar. You want to have your balances, you'll want to have your minimum payments, and you'll want to total them up. Again, you'll want to decide how much extra money you can throw at your debt repayment to help expedite that process even more. And then you'll move from the bottom up, allocating your money towards your accounts. Again, you're going to pay minimum payments on every account except for the very top one. So in our case, that means $350 for the car loan, $800 for the mortgage, and $150 for a credit card. Again, about 8 or 9 months down the road, you're going to pay off that credit card. And you're going to be facing the same choice. Do I pull back this money into my daily spending, or do I roll it onto the next account on the list? And you guys already know the answer there. We're going to roll it to the next account on the list. So instead of paying $800 on the mortgage, we now are going to pay $950. Now, this is a really cool example because as you guys understand, we're going to pay off the car loan way before we're going to pay off the mortgage loan. So we won't be rolling this account down. Instead, once our car loan is paid off, we'll be rolling the balance up and increasing our mortgage payment to $1,300 in this case. Again, this $1,300 will allow us to pay off our mortgage balance as fast as possible. And once it is paid off, we are able to pull all of that money into our daily budget and use it for whatever we want. Vacations, travel, home improvement, whatever you like. Again, as with the previous debt repayment strategy, try not to get any new debt as you're working on repaying your old debt. And then always roll up or down your freed up money into the next available account. Last but not least is debt consolidation, or a game of musical chairs as I like to call it. Now this strategy is pretty unique because there's not a one-size-fits-all approach here. Instead, the approach you take is going to largely depend on your unique situation. Now, so why would someone want to consolidate their debt? There can be a few reasons. First one, maybe you have multiple accounts and you want to consolidate them into one and make just one monthly payment. Second one, maybe you have high interest accounts and you want to move towards lower interest accounts to save some money and be able to get out of debt faster. And the third one, and most common one, is you want to do both. You have multiple accounts with high interest and you want to consolidate them into fewer accounts with lower interest. Now in most cases, for most people, this means credit cards. So maybe you have multiple credit cards with really high interest. So those these days can charge 20, 25, as much as 30% on the balances that you carry. And it can be really hard to pay off those balances with the interest rates being so hard. So if that's you, then maybe consolidation is something you want to consider. So how can you accomplish this? Well, you can take one of two routes, really. You can either go the secured debt route or the unsecured debt route. The main difference here is that secured debt is backed by a collateral. In most cases, that would be your car if you have it paid off, or your home if you have equity in your home. And then the unsecured debt route, it's just that there's no collateral, just a personal loan, a signature loan that you would obtain on your behalf. Now, the interest rates for a secured debt will typically be lower than for an unsecured debt just because you are putting that collateral down, but there are some exceptions. The most common exception being those balance transfer offers on credit cards that we see from time to time, where you can roll a balance from one card or several cards onto a new card. You would get a 0% interest rate. All you have to pay is the 3% transfer fee. The catch there is that the balance has to be paid off in under 12 months. If it's not, then you are going to be paying that back interest pretty quickly in year 2. So if you do have credit cards that you're consolidating and you think that you can pay them off in under 12 months, then do consider that balance transfer offer. If you think it's going to take you more than 12 months, then maybe a secured debt is a better option to go for you, especially if you have a car that's paid off or some equity in your home. As an alternative, you could keep transferring your balance every single year, but that's when it becomes pretty cumbersome and you really want to pay attention when your promotional offers expire. So this is debt consolidation in a nutshell. Well, this is it for today. Please subscribe to my channel where I talk about budgeting family finances without sacrificing fun and fulfilling family life. And if this video was helpful, please consider giving it a like. This was Alona. I'll see you in my next video.